stop scratching. Look, trade execution is simple. You enter a trade for a reason. You place the stop at the price that invalidates that trade idea. You observe all the objective information that the market is giving you in real time, and then either your trade gets hit at its stop or it goes to target. That is trade execution 101. Now, if you're someone who's scratching a lot of trades, you have to be asking yourself, why? What objective piece of information has the market presented to you that gives you sufficient evidence to scratch what was otherwise a very valid, strong idea? Now, I will tell you the reasons that traders I mentor give me as to why they scratch trades. I'm going to show you exactly why they think they're scratching the trades. And then more importantly, I'm going to tell you the exact reasons in which you should be scratching trades. Now, what is a scratch? Well, to begin with, a scratch is just a trade that is closed at or near your entry price. Okay, so you enter the market, perhaps it goes up, perhaps it goes down, but the result is you get out very, very close to where that entry price is, and it results in not necessarily a big win or a loss. It's just somewhere around your entry price. Okay, now, there are 6 reasons. Good reasons, perhaps, yes. There are 6 reasons why traders I mentor tell me why they're scratching trades. And I'm going to go through them with you. And hopefully you can relate to them, because you're probably going to go, oh, yeah, I do it for that reason. Yeah, I do it for that reason as well. Then what I'm going to do is I'm going to showcase to you why those reasons are not necessarily wrong, but they need to be improved upon. Okay, and that's how we're going to start adopting scratching as a strategy rather than just an offset. Okay, so reason number 1 that traders scratch trades is because the trade is not performing as they expect it to. Okay, it's showing signs of perhaps moving against the trader, and to avoid potentially losing money, they simply exit the trade. That is the most common reason. I exited because it wasn't doing what I expected it to do. Okay, reason number 2. When a trader scratches a trade, they're preserving the capital for a different opportunity. So it's a trade-off. It's, oh, I'm going to get out of this S&P trade. It's not quite going. I'll rather come back this afternoon and do another trade. Okay, so it's opportunity cost. The third reason, traders exit because the trade is not performing as they expected, and because it's putting them under a little bit of psychological impact. They want that relief. Okay, so they've sat in a trade perhaps for an hour. Normally they only sit in a trade for 30 minutes. They're not used to sitting in a trade for so long. So they want desperately that psychological relief. They want to go back to that comfort zone of not having money at risk. Okay, so to sustain emotional energy, they effectively exit the trade and look for better opportunities, or at least perceived better opportunities. Reason number 4. Scratching a trade allows the trader to focus instead on another idea. Okay, if I'm in the ES and I've sat there for an hour, I am foregoing other markets or other potential opportunities. Okay, so when I scratch, I can divert my attention and my energy somewhere else. Reason number 5, when the market conditions change and sentiment suddenly shifts, scratching a trade is a very, very good way to reassess. Okay, I exit, flatten, become a little bit more objective, assess the information, and partake in the new market environment. And the final reason traders give me for exiting trades or scratching trades is that they exit a trade at or near that break even, because it allows them to reset. Okay, so when you're having a bit of a difficult day, perhaps your rhythm is a little bit off, hitting that reset button effectively just allows you to take a step back, blank page, start again. Okay, those are the 6 most common reasons. When I prompt the trader, I say, look, you scratched 4 trades today. Those 6 reasons are why traders scratch trades. Now, hopefully you're all looking at that list and going, yeah, actually, that's pretty much bang on the list of reasons why I scratch trades. Okay, now we all scratch trades. Let's be realistic. It's not that we don't scratch trades, but very, very important. Scratching trades is a strategic decision. And it's aimed ultimately at maintaining financial and psychological stability. Okay, it's done intentionally, always, not sometimes, always. We're always intentionally wanting to scratch. It's never emotional. Okay, there must always be a valid, repeatable reason to scratch a trade. I cannot stress that enough. If you scratch a trade, there's got to be a valid, repeatable reason as to why you did it. Now, I'm going to repeat this sort of paragraph a few times to you, but I'm going to illustrate it now with some more examples, okay? Here's the first example. If I fat finger a trade, and it happens to me, and it's happened to me plenty of times in my career, okay? So for example, if I use 100 lots instead of 10, I don't think. I hit the market for 100 lots and I accept whatever happens, okay? I don't care where the market goes. I simply exit, okay? Another example. If I'm in a leverage position, so I've got a reasonably decent sized position on going into a key economic data point, I flatten the trade and I try and reestablish the trade after the data, okay? These are two valid, repeatable reasons to scratch a trade, because every single time there's a key economic data point and I've got a leverage position on, I scratch the trade. It's objective, it's sound, it's logical, it's valid, it's intentional. Okay, there is no discretion involved. There's no maybe I should, maybe I shouldn't. No, it's objective in nature, and that's what makes it strategic in nature. Now, like I said, these are very repeatable strategic decisions that we have to be doing every single time. There is zero discretion involved. Most of these 6 reasons I gave you previously, there's too much discretion involved. And I'm going to show you how to minimize and eliminate that discretion in a minute. Okay. Now, it is okay for you to scratch, but only when there's 100% objective reason to do so. And that's what I want you to get at, okay, is it's fine to scratch as a strategy, but you do it because of 100% objectivity, not 50%, 100% objectivity, okay? And this is the only instance in which you should be scratching. Now, let me be real with you. 99% of traders scratch their trades for the wrong reason, okay? And I can tell you, every trader I've met, I prompt them, why did you scratch? And 99% of the time, they're doing it for the wrong reasons. Even though, sure, maybe it's nice to just kind of hit the reset button because you want to start all over again. Just because it feels good in the moment doesn't mean you're doing it for the right reasons, okay? And that's important to stress. Now, more often than not, it's the fear of losing money on the trade that's ultimately getting traders to exit trades, okay? It's always got to do something along the lines of emotion, okay? And that's why we've got to instill objectivity into the process. If you do that, you're going to stop scratching for emotional reasons, and you'll only scratch when there's logical reasons to do so. Remember what I said to you right at the beginning? The trade process is simple. You enter a trade, you have an idea, you put a stop in place, you put a target in place, okay? Scratching ultimately is not part of that process. We scratch when it's strategically possible to do so, okay? In other words, when it's in our best interest and it's advantageous to do so. Now, you'll quickly come to understand that there are 101 reasons why you are scratching. Okay, if you go and list every single day and you're honest and upfront with yourself and you write down exactly why you scratch a trade, you're going to find that your reasons vary, and there's lots of different reasons. And that in its own is problematic because that showcases that discretionary nature of why you're scratching. Okay. Moreover, if you've got that many reasons for scratching, none of them are repeatable. Okay. And all of them are just discretionary feelings. And that's why I want you to eliminate it. Okay. Like I said, scratching is a strategy. It's not a comfort mechanism. Now, here are 4 reasons on the screen why and where you can scratch. Number 1, key fundamental news. Okay. If, for example, right now, it comes out over the wires, the US imposes 100% tariffs on all AI chips imported from China. That is key fundamental news that overrides everything else. It doesn't matter what market you're in or why you're in, that trade has to be exited at a scratch, okay, or as close to a scratch as possible. There's no logical reason why you would want to wait a little bit. You simply just exit the market, okay? Something has changed, the dynamic has changed, and you exit. The next reason, as I mentioned, key economic data points, okay? Think of US CPI, think of US non-farm payrolls. When a data point, and this is the key, when an economic data point has the ability to shift the rates curve, in other words, it's got the ability to change what the rates markets do in terms of hikes and cuts, that's the kind of data point you do not want to be holding trades over, not as a day trader. If you're a swing trader that's got massive stops, that's got a 5% stop in the S&P, fine, you can ignore this. Okay, most of you are day traders. So in that instance, key economic data points, scratch your trade, try and reestablish afterwards. Okay, the next reason, proxy market signaling. All right, what is a proxy market? A proxy market is a leading market. It's the market that's ultimately pulling or driving your market. Okay, now the way to understand if a market is driving your market is to look at correlations. If there's a very strong positive correlation or even a strong negative correlation between your market and the proxy, it means a relationship exists. Now, when the proxy market starts telling you your trade idea is invalid, don't ignore it. Okay, listen to it and accept it. Now, a good example is currently AI has been the trend for all of 2024. As we're currently seeing in the markets, AI is a little bit scared at the moment, and the entire market dynamic changes. Okay, so we've got to pay attention to those key proxy markets because when they move, our thesis effectively is called into question. Okay, and the fourth reason, and this is now where I'm going to get you to be more strategic, we use something called objective failure characteristics. Think of this as statistical evidence. The statistical evidence says to me that this trade is no longer valid. Now, when we lean on statistical evidence, that is objective in nature, it's repeatable, and it's ultimately something we can deploy strategically. Okay, and this is what I'm going to spend a little bit of time going through now. Now, what you can see in this image is an example coming from the Tradelo application. These are strategic characteristics. They're failure characteristics that's telling the trader that if he sees these characteristics, he should be exiting the trade, not waiting around, not hanging on for more information, exiting the trade, because statistically speaking, when these characteristics are relevant or are prevalent in the market, ultimately that trade is going to likely lead to failure. Now, let me give you an example. So what a failure characteristic is, it's nothing other than a piece of information. It's an objective piece of information coming from the market. Okay, so the market's moving, and ultimately the market is not holding the initiative price action. In other words, we've got a lot of aggressive price action. This is for a breakout. Okay, so we've got a lot of aggressive price action. The market's initiating. It's very quickly rolling through prices, lifting prices off the offer. If it's not holding that initiative price action that it started off with, more often than not, that trade is going to fail. That breakout is not a clean textbook breakout, and it's likely to fail. Now, if we see that objective piece of information, then and only then can we scale back and exit that trade for a scratch. Why? Because we're leaning on objective information that is repeatable. In other words, we're leaning on characteristics that statistically are telling us this trade is likely to fail. Okay? In those instances, it makes absolute sense to take advantage of knowing that this piece of information is likely to imply my trade is going to lose money. Okay, and these are the kind of characteristics we lean on as objective failure characteristics. Now, I'm going to show you this with an example, and I'm going to lean on 3 characteristics to really highlight why this methodology works and ultimately why you need to adopt this methodology so that you can just stop scratching your trades. Okay, so what you do, it's very simple. Take your trade strategy, go and list the key characteristics that are always relevant when your trade is failing. In other words, look at all the times your trade doesn't work. Go and list the characteristics that implied that trade didn't work. And what you'll see when you have enough trade opportunities is that the same characteristics keep showcasing. They keep propping up time and time again. Those are the characteristics you want to go and list. You want to count them. That's what the X50 is. That's what the X35 is. It's counting every single time you see that characteristics when your trade strategy is failing. And what you'll start to notice is that they repeat time and time again. Now, if you find that 50 times, if ultimately price is unchanged after a 5-minute period of time with a breakout, if ultimately you see that characteristic occurring so frequently, and normally that leads to breakouts failing, you can then go and scratch that trade very strategically. And what will happen is you'll stop taking the full losses on your breakout trades. You'll start getting out of breakout trades a little bit quicker, sometimes locking in small winners, sometimes locking in small losers. But the reality is you're not losing as much as you would otherwise. Okay, this is how we deploy strategic scratching. We do not just simply scratch a trade because it feels right, because it makes us feel comfortable, because we want to do something else later on the day. That's rubbish. It's discretion, and it's costing you a lot of time, energy, and money. We scratch because we've got objective reasons to do so. Now, for example, I'm just going to take you through these 3 examples in the breakout. If a market breaks out, okay, we're above resistance, and ultimately on an M5, it's a 5-minute time frame. On an M5, we get a trade that's unchanged. In other words, price has not been able to move higher or lower from where it opened after breaking out. In other words, the trade's broken up, it's above this resistance level, and price is unchanged for a whole 5 minutes after it's broken out. That is a very strong clue that this trade is going to fail. Okay. Moreover, if we see absorption through the break, okay, you get your footprint up. If you're seeing a lot of absorption and price not moving higher, in other words, you're starting to see a lot of overlap in prices, okay, and you're seeing a lot of absorption, two-way trade, that's not a characteristic you want to see on a breakout, okay, and it means that your trade's likely to fail. Weak closes, okay, in the first M15, in the first 15-minute candle, if you've got a weak close, in other words, we break, we get to the upside, but we close back down below inside that breakout point, that is a very strong characteristic that your trade's going to fail. Okay? If you see any one of these characteristics or a combination of these characteristics, it's telling you get out of the trade. The thesis is invalid. The market objectively is giving you the information that suggests your trade's not going to make money. In that instance, we scratch the trade. Okay? And that ultimately, those are the 4 different ways we can deploy scratching strategically. Okay, I want to repeat. Scratching trades is a strategic decision aimed at maintaining financial and psychological stability. There is nothing worse than getting into a breakout, scratching the trade because you're chicken shit. That is psychologically more damaging than ultimately getting out of a trade because you saw absorption, because you saw a weak close. Okay? You have to use scratching intentionally always, never emotionally. There must be valid, repeatable reasons to scratch a trade. Do that, and you'll start scratching for the right reasons.